Hello, and welcome to Portfolio Matters, weekly markets checklist, week 128. But before we get into it, I will read the disclaimer. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware we will be discussing securities that we own or have a financial interest in. Please do your own research, consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Okay, we have a packed weekly this week, and Stuart Owen is joining us and will give us an update on his portfolio towards the end. Some housekeeping before we begin. We will be having another live Discord Q&A with Rogue Trader on Wednesday. That's this coming Wednesday at 7:30 p.m. I hope you can join us. Okay, news this week. Well, it was a busy week. First of all, the Bank of England raised interest rates by 25 basis points to 5.25% and left the window open for further rate rises when they next meet in September. Now, Fitch downgraded the US's credit rating to AA+, and it cited the erosion of governance, rising deficits, rising debt levels, unaddressed medium-term fiscal challenges, and the rise in the interest bill on the federal debt caused by the Fed rate hikes as reasons for its downgrade. Now, US government bonds then sold off heavily, and that affected long bond yields around the world. However, then on Friday, US non-farm payrolls missed expectations, and they came in at only 187,000 in July, and that caused the market to change its mind, and bond yields fell heavily on Friday afternoon as the market started to discount a slowdown in the US economy. Elsewhere, EU GDP rose by 0.3% quarter on quarter in Q2, which was better than expected, and unemployment in the EU fell to an all-time low. So, although the EU economy is not doing well, the labour market there is still very tight. And then on Friday night, after markets had closed, Ukraine attacked a Russian oil tanker in the Black Sea in a port in Russia on Russia's Black Sea coast. And they stated that all Russian ports were now legitimate war targets. Now, Russian Black Sea exports around 350,000 barrels a day. So that could tighten the oil market by making exports from the Black Sea more difficult. In addition, Saudi Arabia announced it would extend its 1 million barrel a day production cut by a month to the end of September. And China has vowed to ease mortgage credit to support its housing market. Okay, some charts relating to the news. Well, this is UK interest rates, and they have risen very quickly, as have interest rates around the world. And reminder, interest rates work with long and variable lags, and the net effect of those interest rates rises has yet to be fully felt. Now, talking about the Fitch downgrade of the US credit rating, well, these are the credit ratings of some major countries. So the EU is now best, with the US now rated AA+ by Fitch and by the S&P. The UK has been downgraded recently by both Moody's and Fitch and is AA- according to Fitch, so substantially worse than the US, although still of a high rating. China, I was surprised by how bad both China and Japan's credit ratings were. Japan, in particular, has a lower credit rating than China. Stuart, you got any thoughts on that?
Well, it's a weird situation, isn't it? You look at any of the statistics for major countries or blocks, and you go, oh my God, this is awful. So Japan, the US, wherever. But of course, you're dealing with a sovereign who's always got the ability to print.
Yes.
To some extent, the credit rating, it's not really a default risk rating. It's a sort of chaos and inflation risk rating. So it's a strange situation. We don't really expect them not to pay, but it's a question of sort of what the chaos is when finally it hits the fan and dramatic actions have to be taken.
Well, I suppose the risk is not that you don't get repaid, but you get repaid in highly devalued currency. And, given that Japan has a sovereign debt to GDP ratio of about 250%, I mean, the debt is just totally not repayable. And so, they can continue to print money. And at some stage, the disaster scenario is that, people start spending that money, inflation picks up, and you just get into a terrible spiral.
Well, when I was living in Japan, I think the amount of debt was the equivalent of $100,000 per person, man, woman, and child.
Yeah.
And that was 10 years ago. So, 200 grand per person. It's all a bit sort of Alice in Wonderland, isn't it? And yet, the music plays on, everyone's still dancing.
Yes.
But you do have to worry and construct your portfolio with some sort of insurance in there. If you're me, or if you're you have to be very nimble and pay attention to what's happening.
Well, I was contemplating after Fitch downgraded the US's sovereign rating, I was contemplating the fact that actually, I don't think you want governments to pay down the debt entirely or even by very much, because that is an asset for the financial system, for private citizens and corporations. And if they were to pay down the debt, they would get rid of a lot of financial assets. And what would they then replace it with? You would basically have to destroy the money supply. You'd shrink the financial assets of the country.
But that's an argument for let's keep spinning faster and faster and faster because we can't afford to slow down.
Well, but I suppose what I'm really saying is that you don't want the debts to keep on increasing at an unsustainable rate, but shrinking them is another matter entirely.
Wouldn't it be nice if both money supply and debt, vaguely approximated nominal GDP in terms of their growth rates? But it's never really like that.
The thing about Japan is that they keep on printing money to monetize the debt. And at some stage, that surely becomes unsustainable. And that money, which is sitting on banks, if people in Japan start to lose confidence in the financial system, they start spending money, then the inflation would spiral out of control. The interest rates on Japanese bonds would rise uncontrollably, and you'd rapidly lead to a financial crisis. That's the worst case scenario.
Absolutely. And this is why I think it's interesting to think of money, not so much in an economic perspective, but almost like in a social perspective. It is when confidence is lost. And in Japan, when you've had 30 years of deflation, that in a sense is a bulwark. People haven't lost faith in literal money. I wondered whether the moment of crisis might have been coming when Japan suddenly started having a current account deficit, where previously it was at least earning more from trade and investments than it was spending. But that didn't prove to be the crisis moment. Though having said that, the yen has weakened a lot.
Yeah. But the other thing I'd say about Japan is it's a very socially cohesive society. So if the social norm is to continue keeping your money in the bank and to trust the government, people are kind of inclined to. I don't think that would work as well in the US or the UK, frankly.
I think that's true, though there is an academic school of thought that Japan stays the same, and then makes sudden changes. So, you could get some sort of crack in the ice. And when you look at the behavior of young people in Japan, there's surprising sort of levels of resistance. I think what the Chinese called lying flat, people avoiding engaging in the economy and society because it's just such a hard grinding process.
Interesting. Okay, well, this is the US 10-year bond yield, which rose sharply over the course of the week, only to reverse course on Friday. And you see, when it rises very quickly, there is quite a lot of mean reversion in this chart. Now, Fitch's concerns about US debt sustainability would seem to be well-founded. The top chart shows the expected path of the deficit, and the bottom chart shows the expected path of total fiscal debt, both of which appear unsustainable. Medium term, the US government is going to have to address the fiscal deficit. However, the CDS market was totally unfazed by the Fitch downgrade. So the cost of insuring US debt shot up earlier in the year over the debt ceiling standoff and have now collapsed to essentially nothing. But the US is set to sell $1 trillion worth of debt this quarter. So Fitch's other concerns about just the size of the US debt and actually whether the bond market will be able to digest that amount of issuance also appear well-founded. Now, the oil market had an interesting week with Saudi Arabia announcing that it intends to extend its 1 million barrel a day oil supply cut by a month into September. But then after market closed, we had a Ukrainian drone carrying 450 kilograms of TNT hitting a Russian oil tanker in a Russian Black Sea port. So Monday, oil prices could rise further, and the strike was on a vessel in Novorossiysk, he says. So very much in Russian territory, and Russia exports around 350,000 barrels a day of oil via tankers from the Black Sea. So
that's going to put the US in a bit of a spot, isn't it? Because on the one hand, they're supporting Ukraine. On the other, they don't want petrol prices rising before the election. And this may do that. And we know what they did last year with release of reserves.
Well, I would have thought, Stuart, that the net effect is probably going to raise oil prices due to anxiety rather than the actual effect. I mean, 350,000 barrels a day in the context of an oil market of 100 million is really not very much. And how much of that do you think is going to be disrupted? 10%, 20%? Really not very much, but it adds to a tightening market. And the Bank of Japan, having said that it would allow the 10-year yield to rise to between 0.5 and 1%, has had to intervene twice last week to stop the JGB yield rising too far. So going back to our earlier point, it would seem that Japan is addicted to QE. And if the Bank of Japan were to stop buying bonds, then bond yields could rise a lot further. And then you could see the sort of debt spiral that we fear. Okay, on to this week's economic data. Stuart.
Okay, UK consumer credit was actually surprisingly strong. Here we go. Expectations 1.3 billion. It actually came in more like 1.7. So somewhat surprisingly, people are borrowing.
Yeah, this is always a double-edged sword, though. Because are they borrowing because they're confident, or are they borrowing because they're desperate? I don't really know.
Mortgage approvals. This one was in the headlines, wasn't it? Surprising bounce back. I'm somewhat worried by this when you read stories of people taking 35, 40-year mortgages. I sometimes wonder whether people, a bit like in the stock market, you hope it's going to bounce back to the good old days, and perhaps people are hoping that or desperate to get on the housing ladder, thinking it only goes up, and so they're stretching themselves.
Yeah. Odd.
Net mortgage lending has bounced back to zero after some repayments over the past couple of months. Okay, so here we have UK M4, one of the measures of money supply, and we're looking here at the stock of M4. I would think the Bank of England would be pleased to see the basic flattening or flat picture this year.
Yeah. I should say that is M4 month on month.
Car registrations year on year, up 28% in July after 26% in June. So surprising robustness there as well.
Yeah, again, the chart is of the absolute number of registrations. And I put in a red line so you could compare the July number with history. And I think what you can say is that it is getting back towards pre-pandemic levels. Of course, all these, the car registration numbers are distorted by the fact that the supply chains for cars were so disrupted and manufacturing is only just now getting back to normal.
Continuing on the UK, the S&P Global Construction PMI was better than expected, up on the prior month, and expectations of 48, i.e. a slight contraction, were beaten. It came in at 51.7, so reasonable numbers for the UK there.
So I'm going to read this out. The S&P Global CIPS UK construction PMIs rose to 51.7 in July, beating market expectations of 48 and up from 48.9 in June. Although indicative of modest growth, it marked the strongest reading in 5 months, driven by robust increases from commercial building and civil engineering. However, this was offset by a steep fall in residential work. In June, new orders growth slowed below the average seen in the first half of the year as rising borrowing costs continued to hamper sales. Now, we know that the house builders have been cutting back their housing completions this year hard. So Persimmon, I believe, we're talking about 42% lower completions. So it just goes to show that the commercial and civil engineering business, it must be doing very well to offset that.
Amazing, isn't it? I mean, we would not have been surprised by that in the States, given all the fiscal support there. But what's being built in the UK? I thought we didn't build anything.
I don't know. So it's amazing.
EU GDP quarter on quarter. This is just a flash number. But previously, we've been talking about Europe having a technical recession. Well, based on the latest numbers and revisions, that has gone away.
Yes.
Previously, there was a minus 0.1 for the first quarter. That's now 0. And the second quarter came in at plus 0.3. So it's more of a pancake. It's more of a flatlining rather than a fall. And looking at that in year-on-year terms, just about above 0. European CPI month-on-month, modest deflation in July, minus 0.1%, though expectations had been for minus 0.2%. So again, it's a flatlining situation.
Well, that's good, Rich. That's good, Stuart. Minus 0.1%. We're in deflation. That should bring inflation down pretty fast.
Looking at the same statistic on a year-on-year basis, it does look like the peak of the Matterhorn has been scaled and we're on a clear downward trend. However, I think we're about to look at the core, aren't we, which doesn't look like that. That looks more like Keith at the top of a mountain going for a long hike and not on the way back down yet.
Yes. Yeah, no, that is concerning.
Economic sentiment, as usual, rather depressed. Expectations were of a score of 95. It came in at 94.5. So rather gloomy, as usual.
Yeah, but the bounce we saw in Q1 and Q2 is now fading.
Consumer confidence. Well, this is relatively joyous news, coming in at minus 15, where previously, earlier in the year, it was almost touching minus 30. I think we've spoken before about consumer confidence in Europe always being a negative number. So it's not great, but less bad than it has been.
Yeah, extraordinary.
Industrial sentiment, however, is pretty grim. A pretty awful chart here. Expectations were of -7.5, came in at -9.4. Not good.
Yeah, that's a really bad number.
Services sentiment, however, okay, it's come off a little bit, but just about above zero. Expectations were 5.4. The number came in at 5.7, but not too bad.
Yeah, but again, fading.
Consumer inflation expectations now coming in at 4.8. This is not 4.8%. This is presumably inflation is going to be higher or lower type balance question. But having been as high as 60 on this scale at the beginning of 2022, expectations for bad inflation seem to have evaporated. EU selling price expectations, again, showing the same pattern of, yes, we've been through an awful period, but now we're sort of back to normal, coming in at 3.4 on this scale, but basically back to sort of levels that were seen 2018, 2019, 2020. Unemployment rate, as I think you mentioned, Keith, in the headlines, very weak. Unemployment weak, i.e. people employed. Expectations are of 6.5%. Unemployment came in at 6.4, and the May number is revised down to also to 6.4 from 6.5. So, reasonable labour market in Europe.
Well, a very tight labour market in Europe. Astonishing.
European PPIs month on month. Oh goodness, this is all year has been negative. Deflation everywhere. Expectations were of another -0.2% reduction in PPIs. Actually came in at -0.4. So that looks pretty strangling for European producers. PPI year on year. Oh, I see. Right. So well, here we are. It had been reaching plus 40%. And now is at -3.4%. So it's gone through the pig has gone through the python, as it were.
Yeah. You'd hope that this will feed through to rapidly falling inflation in the Eurozone. But as we've just seen, the core number remains persistently high.
EU construction PMIs are pretty weak here. A little bounce a few months ago, but now down to 43.5 against expectations of 44.5. But yes, pretty poor.
Yeah, but again, you expect the construction sector, and the construction sector in Europe is clearly weak and weakening, to be shedding jobs, leading to rising unemployment. And we're just not seeing it yet. The EU unemployment rate is an all-time low.
EU retail sales month on month, a pretty weak number, -0.3. Having said that, the previous month's number of 0 has been revised up to 0.6%. So looking over the past 3 or 4 or 5 months, to me, this just looks like flatlining.
Yeah, I think that's very poor, actually. Changing last month's from 0 to 0.6. I mean, that's a big revision.
And looking at that year over year, coming back towards 0 after having been pretty remorselessly down for the past few months. So, yeah, well, as I keep saying, this looks like a pancake to me, very flat in terms of the overall level of retail sales. US personal spending, however, month on month, a pretty robust number. Expectations of up 0.4 were beaten. It was up by 0.5. But when you look at the past 6 months, that's a pretty respectable performance.
Yeah.
Personal income month on month, however, not quite as good as expectations of 0.5%. It was up just 0.3%. But you compound up the past 6-7 months, it again is looking perfectly respectable. US PCE inflation month on month, 0.2%, bang in line with expectations. And presumably, if you annualize that, that comes into the sort of number the Fed would be quite happy with.
Absolutely.
PCE inflation year over year, having peaked at almost 7%, now looks like 3%, bang in line with expectations. And I believe this is the measure the Fed most looks at. So a pretty good result. US core PCE inflation month over month, 0.2%. I think the Fed would be very happy. And looking at that year over year, that's now coming off pretty sharply, having peaked at almost 5.5%, is now just 4.1%. So looking pretty healthy in the US.
Yeah, I think the US is getting inflation under control. And when you look at the monthly numbers and annualize them, then, you're pretty close to target, frankly.
US employment costs quarter on quarter, again, looking like a vaguely reassuring picture. Expectations were 1.1%, came in at 1%. So again, annualizing that looks perfectly respectable. And the peak seems to have been passed at the beginning of 2022. US JOLTS job openings, at last some sort of sign of weakness in the US labor market, but it's only weak compared to the big peak of 2022. The job openings is nothing like the pre-pandemic level.
Yeah, that's true. But the trouble with the JOLTS numbers, you just don't know how many of these job advertisements are live. So to be treated with some caution.
The JOLTS report also contained data on monthly hirings, which fell to below 6 million a month for the first time since the recovery from the pandemic began. So some softening in the labour market, which I think the Fed would be pleased to see. The quits rate, which I know has attracted a lot of attention over the years, indicating people's willingness to take a risk and to move jobs. That also showing some weakening, still reasonably elevated compared to pre-pandemic levels, but not half as good as 2022. US ISM manufacturing PMI, beginning to bottom out, but not that healthy. Expectations were 46.8, and July was 46.4. And given some of the numbers we've seen elsewhere about industrial production and construction, this number rather surprises me. US ISM manufacturing employment, that's a pretty weak number, isn't it? Goodness, that's collapsed from bouncing around 50 to pretty decisively below. Expectations were 48, came in at 44.4. US ISM manufacturing prices came in at 42.6, pretty much up on expectations of 42.8. I don't think that we can say too much about that, really.
Well, it shows that manufacturers don't feel that they can raise prices. Prices are weakening. So that's good.
New orders bouncing a bit. That's quite encouraging. Coming in at 47.3 against expectations of 44. Services PMI showing a bit of weakness for still above 50, still expanding, but not as strongly as earlier in the year and last year, coming in at 52.7 against expectations of 53.
Yeah, and now the downtrend is sort of re-established.
Services employment, that looks just about hovering above 50, as it has been for the past 18 months. So gentle, small expansion in services employment. Services activity, pretty decent last couple of months, it seems to me. Expectation for 57.2 came in at 57.1, but that's a pretty strong number, which it has been for the past 18 months or a couple of years. Services prices paid bounced a bit. I think the Fed would have been pleased with this strong trend down from well over 80 to mid-50s, but that's bounced now up to 56.8. Something slightly to worry about. New orders in services, again, pretty decent, cooling off perhaps a bit compared to last year, but coming in at 55, suggesting a decent pace of expansion. US factory orders month on month, a blistering number here, goodness.
Yeah.
There were expectations actually of up 2.2%, so people knew something. Economists got it vaguely right for once. Came in at 2.3. I don't know if there's anything to do with the various fiscal stimulus programs for chips and for infrastructure, but that was certainly expected, that big number.
Yeah, I think a lot of that is aircraft, though. That's certainly the case in Germany, where you had a massive order of 920 planes for Airbus. Moving on to US non-farm payrolls. So the July number came in worse than expectations. Expectations were for job growth to slow to 200,000. But the June number was also revised down. So last month we reported 209,000 jobs created. That's been now revised down to 185,000. But if you dig into the numbers, you get quite a different picture from the headline. So first of all, the non-farm payrolls headline number has been revised downwards for 6 months in a row. And we've talked previously about how the revisions are themselves decent predictors of future GDP. So falling revisions means that the labor market is weakening more than expected. But the big thing was that if you look at the number of full-time jobs created in July, then they were terrible. So there was actually a drop of 585,000 full-time workers in July. And that was offset by an increase in 972,000 part-time workers. And there are 118,000 multiple job holders. So you then get a picture that although the US economy is still creating jobs, they're increasingly poor quality part-time jobs, and it is losing full-time workers. Now, I double-checked that full-time worker number, and this is from the St. Louis Fed, and you can see that the number of full-time workers did indeed drop by 585,000 in July. And also, the jobs created, 61% of them came from government, education, or health services, i.e. non-cyclical. So if you look at the US labor market, and here the jobs are split into the green is non-cyclical, i.e. government, private education, and health, whereas the red is total and blue is private cyclical, so excluding government, education, and health. Then you'll see that what causes a recession is that downturn in private sector cyclical jobs. And right now, the annual change in private sector jobs is trending steadily downwards. And this is absolute numbers. And if you look at the monthly change in private sector jobs, you get a distinct trend of falling job creation. So it looks to me like the Fed is actually having some effect. And despite the US still continuing to create jobs, actually the labor market is weakening steadily. And you would expect within the next few quarters that the US labor market will start shedding jobs. Now, I've also prepared a segment on the US student loans. Reminder that following the Supreme Court ruling, people in the US with student loans become liable to start paying their loans again from the 1st of September, and payments start again in October. Now, we don't have space this week, but next week we will discuss that. And that can be expected to reduce US discretionary spending by between 9 and 15%. So it will have an effect at the margin. Now, obviously, discretionary spending is not the whole of consumer spending, but it is an important component of it. And it will particularly affect large durable goods manufacturers. And the other thing in the non-farm payrolls was that temporary help services, which is perhaps the most sensitive sector of the jobs market to changes in demand, continues to fall year on year. All indications that the jobs market is weakening. Stuart, back to you.
I was fascinated with your chart for that pattern of revisions to the non-farm payrolls, because I recall that there is a component in this calculation, which is what's called the births and deaths model, births and deaths of companies.
Yes.
Now, of course, when these statistics are being compiled, they have to make an estimate of the number of companies being born, the number of companies dying. It's very difficult to do accurately on live. So, of course, what tends to happen is that recent trends get extrapolated. And then, of course, at turning points is exactly when the extrapolation is going to be wrong. So the fact that we've had 6 months now of negative revisions suggests that the birth-deaths model might be contributing as it's gradually being revised in line with reality out there. So I could totally see why these revisions become a predictive tool.
Yeah.
Okay, returning to the data, US average hourly earnings month on month, 0.4% against expectations of 0.3%, perhaps slightly higher than the Fed would want, but sort of inevitable given the inflation picture. Looking at that on a year-over-year basis, we're coming in at 4.4% against expectations of 4.2%. I mean, no, it's not too bad. If I was the Fed, I would be thinking that that's just about acceptable. You'd rather it was a little lower, but given historic inflation, it's not too surprising.
Yeah, they want it lower though. And, it's not coming down as quickly as you'd expect.
US participation rate, this was a big feature, bouncing back from the pandemic. It's still grinding back to pre-pandemic levels, just a bit below, it would seem to me, coming in at 62.6%. US weekly hours worked. Oh, this has been coming off. That's again a sign of some cooling in the labour market, down to 34.3, having peaked at 35 hours per week worked.
Yeah, and I put in this red line here because I think that's about the low of a normal economy. Below that, I think you start cutting workers. So,
US ADP employment change. Expectations were of 189. Actually, it was a lot better than that, coming in at 324,000, which was down on the prior month, but that was a blockbuster of 455. So, as ever, slightly mixed messages. Looking at cooling data in other measures, but this looking very strong still.
Yeah, odd.
US new vehicle sales monthly annualized. Pretty strong picture there. Though, as you mentioned, Keith, there may be an analogy with the UK position of recovery from problems in the supply chain. But anyhow, 15.7 million on annualized basis in July.
Yeah, no, I think that's right, Stuart. I think the car manufacturers have got their supply chains fixed and now churning out cars again, but consumers still have to afford them. And given the rapid rise in interest rates, then I am surprised by how well car sales have held up, because we do know, and I think I've got a chart later showing the average monthly cost of a new car in the US, and it has shot up since pre-pandemic. So, this is all indicative of consumers both in the US and the UK still having the confidence and the ability to spend on large durable goods.
US and the Chicago PMI are bouncing a bit from low levels, coming in at 42.8, which was weaker than expectations of 43.3. Not too great a picture there. US Dallas Fed Manufacturing Index also recovering, but from very weak levels to weak, coming in at -20. US Logistics Managers Index, that's pretty remorselessly painful, having been hitting a high of over 75, is now down to 45. Not quite sure of the scale, but it's a bad picture.
Yeah, that's the worst ever number. So what it's saying is the retail trade in the US is doing very badly.
I saw in Berkshire Hathaway's report yesterday that their railroad was doing very poorly, not too much being shipped. US Johnson Redbook retail sales, 0.1% year over year. So I think we've spoken about this before. If this is a nominal number, that's pretty painful if you're a retailer dealing with flat revenues in an inflationary environment. US MBA 30-year mortgage rates still pretty painful, 6.93%. Mortgage market index, again, the same stories we've had all year, flat on its back. US initial jobless claims picked up a touch, not a huge number, 227, pretty much the same as a couple of months ago. US continuing jobless claims perked up a bit, but you can't really say it's broken the downtrend.
But what I'd say is that, when we look at the PMIs, there was this bounce in Q1 and Q2, and I think you see the jobs numbers kind of reflecting this. And now that that bounce is coming off, then you'd expect to see the jobless claims rising again. And maybe that's what we're seeing the first intimations of, because the weekly numbers are incredibly noisy.
Turning to China, manufacturing PMI bouncing a little bit, coming in at 49.3, so still just under a neutral reading, a bit better than expected, but not great. The non-manufacturing PMI is still just about above 50, coming in at 51.5, though it was weaker than expectations of 52.9. So therefore, the composite weighted towards services are still just about holding above 50, but has come off over the past few months. Turning to the China Caixin manufacturing PMI, well, we see a rather different picture here, where the previous measure showed weak but bouncing. Here we've got weak and falling. So as ever, we don't really know with China data how it's put together, but a rather muddy picture. Turning to the Caixin services, this is looking a bit more robust, 54.1 against expectations of 52.5, a pretty reasonable reading. Actually, all year it's been just about okay. The composite, therefore, from the Caixin weakening, coming in at 51.9, but still overall suggesting expansion on that measure.
Okay, thanks, Stuart. So in summary, I won't go through these in depth, but pause, take a read. In the UK, we still have interest rates that are rising, and the Bank of England next meets in September and have left the window open for further rate rises. The commentary that went with the Bank of England's decision showed that of the 9 members, 3 dissented, 2 actually voted for 0.5% rises, and 1 voted for no rise. So if the data continues to come in hot in the UK, you can expect further interest rate rises. But the data we had this week showed a resilient UK economy. I was particularly struck by the construction PMI, which came in at 51.7, massively beating expectations. We turn to the EU. Well, inflation in the EU is falling and looks likely to keep on falling, despite the labour market being tight and unemployment in the EU being at an all-time low. But we've seen previously from PMIs that the EU economy is slowing, and the construction PMI we saw this week was really poor, 43.5. So as recent interest rate rises start to feed through, we expect the EU economy to fall further and into a recession in the coming quarters. In the US, well, really interesting data this week. So we had the ISM manufacturing and services PMIs, both of which missed expectations. And above all, we had non-farm payrolls. And digging into the detail of that, although the headline shows that the US continues to create jobs, actually it lost 585,000 full-time jobs, but it gained 900,000 part-time jobs. So further evidence that the US labor market is weakening, although it remains tight and wage growth remains above the Fed's preferences. And finally, China. Well, the NBS and the Caixin surveys basically contradict each other. But if you look at the composites, they both showed an economy which is still growing but is weakening. Okay, and on to errors and corrections. And thank you to our new Discord member, Mr. C. Peckham, for his contributions. And last week I showed you this chart, and we commented that it showed that the US economy is now a third larger than the EU economy. And that is right, but that's in dollar terms. And what Mr. Peckham pointed out is that although that is true in nominal terms, and that's the blue line, if you look at their GDP in PPP terms, actually European GDP has kept up with the US. So what's going on is the euro has collapsed versus the dollar. If you look at the value of the euro at its peak during the great financial crisis, actually, I struggle to remember this, but it's amazing that the euro was then approaching 1.6 to the dollar, and it has since collapsed to 1.1. So the reason Americans are much richer than Europeans now is the fact that the euro has weakened so much. So that's part one of the errors and corrections. Part two is this chart, which we showed last week, and I commented that if you looked at the Chicago Fed National Activity Index over the last quarter, so April, May, and June, well, that adds up to being pretty negative. And we know that actually US GDP in Q2 came in at 2.4% quarter on quarter. And so I commented that the Chicago Fed National Activity Index didn't actually seem to be very useful, in that it was forecasting that GDP would be poor, and it came in at a decent 2.4%. Well, Mr. C. Peckham has pointed out that I have misinterpreted this. And so the Fed National Activity Index is based on 85 different economic series. There's national economic series, and it's constructed to have a value of 0 and a standard deviation of 1. So 0 indicates the US economy is growing at its long-term trend. Negative numbers mean it's growing below trend. Positive means above trend. A value of minus 0.7 is associated with recessions. And so current readings show that the US is growing at below its long-term trend, but is not in recession. And that's kind of what happened. And if you look at the performance of the National Activity Index, and the blue line is the National Activity Index and the red line is GDP, you'll see they're actually very well correlated. So it does work. And let me read this out. So the June reading of the National Activity Index was minus 0.32, which drew the disdain of the PM team, i.e. me, given that Q2 GDP came in at 2.56%. However, the two are actually showing the same result. The average for the National Activity Index in Q2 was minus 0.16, which means that growth was 0.16 standard deviations below the long-term average. To put that another way, the growth rate in Q2 was in the 43rd percentile of all growth rates, and according to the GDP report, at 2.56%, the Q2 growth rate was 0.17% percentage points below the long-term average, i.e. the two reconcile. Now, he does say that Q2 GDP was 2.56%, but the number we reported from the quarterly data was 2.4% annualized. So just to point that out. So in conclusion, well, I now understand the Chicago Fed National Activity Index. Thank you very much to Mr. C. Peckham for correcting us. And it is useful and it does work. And so I take back my earlier criticism of it, and we will continue to report it. Okay, on to one chart. Now, this explains what is going on in the US. So this is from the survey of US small businesses. And if you look at the thin black line, it's their expectations. So it's expected business conditions, their outlook, the expected sales, etc. And that is a really poor number. So when you ask them about how they're feeling about, things going forward, then they feel actually very bad, the worst they've felt since the great financial crisis. But then you ask them what they're actually going to do, and you get a completely different picture. So the thick black line is job creation plans, job openings, inventory plans, earnings, and capital expenditure. And so they're feeling terrible about the future, but they're not planning to cut jobs, and they're not planning to reduce capital expenditure. So that gap explains what's going on in the US economy. So although all the soft data we report regularly on this podcast show that the outlook looks terrible, as long as small businesses and business in general don't react to their pessimism and don't fire people and continue investing, the US economy will remain strong and resilient. Stuart?
Yeah, it's a fascinating decomposition, isn't it? I was trying to think if there was some predictive measure to it, thinking, if reality is decent and sentiment is awful, you would think, aha, let's buy the stock market. However, the stock market appears not to be paying attention to the soft, and is paying remorseless attention to the hard data and the optimism from tech.
Yeah. On to the Senior Loan Officers Survey, Stuart.
Thanks, Keith. So this is a survey based on, I think, about 80 big American banks and about 20 odd foreign banks, asking the senior loan officers what their opinion is. So the usefulness of this is to be gauging trends in credit availability. And as Keith has pointed out in previous episodes, the credit impulse here is what to be thinking about, not just whether credit is going up or down, but whether it's going more up this year than it went up last year. So we have here loans to middle market firms and loan to small firms. This is a tightening measure, and they're pretty pessimistic about the worth of lending to small, medium, or large. So we've gone from a loosening in 2021, a score of -20 on the survey, to a score of about +50 for both sections of the market, which, if you exclude the pandemic, is the tightest we've had since the GFC. So this would appear to be a forward-looking indicator suggesting extreme caution. So this is the same survey, but looking at the demand side, whereas previously we were looking at supply, how willing banks were to lend. This is looking at demand for commercial industrial loans. And again, it's the worst level of demand since the GFC. So not only are banks unwilling to lend, it looks like borrowers are not very keen to borrow either. Credit spreads are widening. This presumably, of course, is loans from banks, which is sharply different from the spread that we see in high-risk credit in the bond market. So again, excluding the pandemic, we're at a very, very tight situation, very analogous to the level seen in the GFC. So this is increasing spreads are being offered by banks when they are willing to extend a loan. So credit spreads for real estate remain very tight. I don't think this surprises us at all. The surprise to me was that in the previous data, we were reporting growth in construction activity. But
Yeah.
here we go. Absolutely, net percent respondents reporting tighter lending standards for real estate loans. Yes, I mean obviously at a plus 70 for commercial real estate. This is demand for loans, so no one is even bothering to ask for a loan, it would seem, because everyone is in retrenchment mode.
But there was a bit of a bounce. It's amazing. Credit conditions tightening, but actually did see some increase in loan demand.
Yeah, I guess I'm looking at the level. Yes, the change has bounced a bit, but it's still a pretty low reading. So loan standards for households have loosened slightly, but they are still pretty restrictive. So we have loans to firms and loans to households here, to firms in green, households in white. So loans to firms, tighter lending standards continue to be reported by the loan officers. It's eased off a bit for households, and we did see some pickup in mortgages, I believe, didn't we? So bank lending typically follows tightening credit standards with a lag of 2 or 3 quarters. So presumably this is very soon coming down the pipe, because the bank lending standards have been rising for a while now. Willingness to make consumer loans leads GDP by a quarter or so. And so again, we would expect that this SLOOS survey is a good predictor of weakness just around the corner. And looking not just at the consumer side, but corporate loans, again, that is predictive of a recession. So we've seen Fed tightening, we've seen tighter lending standards on top of that. So an absolute collapse in demand for C&I loans. That again is a reading last seen in the GFC. Now, if you look at the correlation with weaker payrolls, again, it's there. We're looking at in the sort of brownish line in banks' willingness to make loans, and that leads pretty clearly the total payrolls year-on-year change. So we really appear to be sort of at the Wile E. Coyote moment. Everything is pointing towards a sudden slowdown in credit availability, demand for credit, and the price of credit. So expect tightness to reflect itself in activity and employment pretty soon. Turning to the stock market, however, the change in credit standards against the S&P. Well, I suppose, yes, there is a relationship, isn't there? It's just that the S&P is a bottom left to top right chart, whereas the change in credit standards sort of is a more centered chart. But certainly we saw it in 2001. Of course, we saw it in the GFC. Didn't see it so much in the brief pandemic, but that would suggest that the recent strength of the S&P is living on borrowed time. What is nearly certain is that loan growth will continue to contract, and hence the credit impulse is going to be doubly negative. Not only is it not increasing, it's actually reducing. Delinquency rates on credit cards are now at 7.1%, which is higher than the GFC. So that's a pretty painful amount. I'm not sure if that presumably is over the past year. You're writing off 7.1% of balances is pretty painful. So in summary, US credit conditions remain very tight, and historically tight credit conditions have tended to precede recessions. There has, though, been a little bit of recovery in real estate loan demand from very low levels.
Great, thank you, Stuart. And on to Inflation Watch. Well, we had some flash data from the EU this week. So EU CPI came in at 5.3%, down on July. Core CPI was flat at 5.5%. So inflation remains too high for comfort. Reminder, the ECB raised interest rates again last week. This week, of course, the UK Bank of England raised interest rates by 0.25% to 5.25%. Also, I've changed the Japanese QE graphic to 10-year bond yield maintained between 0.5% and 1%. Okay, so this is from the Bank of England, and they are now forecasting that inflation will fall to around 5% by year end and to the 2% target by Q1 of 2025. So changed from the last time they gave a report, and they're now expecting UK inflation to fall faster. Let's hope they're right. And good news.
We can have Richard on that. I mean, given his comments on inflation forecasting abilities of the BOE, I see that Ben Bernanke's been drafted in to review just what went wrong so often and so badly.
Yes, they need some credibility. So they've turned to the Americans. And some good news, UK shop prices rose 8.4% year on year in June, which was down from May, and food price inflation also fell to 14.6%, down to 15.4%. So UK shop inflation is still very high, but it is falling. Now, in the US, we have talked about this before, but due to the comparators from last year, if inflation stops falling and stabilizes at its current rate, then the comparators mean that year-on-year inflation will start bouncing towards the end of the year. Something to watch out for. And wage inflation just remains too high. If you look at the drivers of manufacturing prices, then energy costs have fallen, raw material costs have fallen, and demand has fallen. But labor costs continue to be persistently high. The Kansas Fed has done some research, and it shows that there's a correlation between the New York Fed Supply Chain Pressure Index and core goods inflation with a 4-month lag. And that's great because the Fed's Supply Chain Pressure Index has continued to fall into quite serious negative territory. And that implies that core goods inflation will continue to fall strongly over the next 4 months. So strong deflationary pressures in US goods prices, hopefully. However, we previously talked about US M2 and how it had been falling year on year. Well, the last couple of months have seen it rise again. But the Fed's multivariate core trend inflation model shows that inflation in the US was actually 2.9% in June, well below the 4.1% reported. And we know that CPI is artificially high due to owner equivalent rents. So that is probably a more accurate measure. And trueflation in the US is down to 2.4%, i.e. nothing to worry about. In the UK, it's 11.64%, and frankly, not falling. So plenty to worry about. But global inflation surprises have disappeared. Essentially, inflation is now surprising to the downside. So in summary, global goods inflation is weak and weakening, but labor markets remain tight and wage growth is too high. Central banks will need to keep rates high to create slack in the labor markets to reduce wage growth to meet their inflation targets, and that implies a recession. Stuart, recession watch.
Right, so global manufacturing is already in a deepening recession. So here we're aggregating PMIs across the world, including APAC, EMEA, Latin America, as well as the standard North America one. So adding all those up, and the picture is grim and has been pretty much for a year now. Company insolvencies in Q2 were at their highest level since 2009. This is data for England and Wales.
Yeah, not good.
Yes, the fan chart from the B. So anything may happen, but if we take their central projection, unemployment does look as if it's likely to be rising, but I mean not to an awful level. Perhaps around 5%, but I mean that's a 3-year forecast, so reasonably mild, to be honest. If something like that came to pass.
Yeah, of course they can't forecast anything drastic.
Employment expectations for the next 3 months in the EU looking pretty weak. No one is seemingly going to be out there recruiting, and yet, as we saw in the EU employment data, people don't seem to be being let go because the unemployment rate was actually down. So somewhat contradictory, but based on this survey, at least, intentions are not for very strong recruitment in the EU.
Yeah, but they're still above the long-term average, which I was surprised by.
Right, 40% of US commercial mortgage-backed securities are maturing by the end of 2024, i.e. we've got a bit of a wall coming, which presumably is going to be a nightmare for the banks which are backing some of this collateral, which are holding some of this collateral.
Yeah.
So, yeah, you're not going to be able to roll on in the way that you have assumed when you launch these things. So, obviously, there is variety within that. And here, the data from Nick Shah on Twitter is breaking CMBS down into hotels, industrial, multifamily, etc. But offices are a pretty big chunk of that over the next couple of years.
Yes.
The share of small businesses planning to increase hiring is falling off a bit. This is in the US, so a bit like the European picture there. So again, the reality on the ground at the moment is employment is reasonably decent, reasonably steady, but the outlook for small businesses at least is hunkering down. US imports have declined year on year. That is something that normally only occurs during a recession, and that's a pretty sharp turnaround, isn't it?
Yep.
US cardboard box demand is not recovering. Amazon will be a major, that they'll be strongly affected by this. Minus 8.3% cardboard box shipments year on year. That's a huge reduction, isn't it? Again, yeah. GFC type levels. Talking of which, activity at US Amazon facilities is close to a 7-year low. Goodness, I wonder how this is measured, but it's a daily aggregation of an area in square meters that change location between 2 consecutive satellite images. Well, there we have it.
Presumably that means the truck movements at US Amazon facilities. And it's amazing that somebody does this, frankly.
Yep. Layoffs in the US tech sector are lower than in Q1, but they're still running at a much higher rate than last year. So in 2023, there have been 223,000 tech layoffs, 60% higher than the whole of last year. Though presumably there's a lot of reallocation going on as everyone recruits in AI, but lays off in other areas.
Yeah.
US corporate profits are negative now year over year. That's normally a sign of a recession, which we can well understand that it's when profits are being hit that you look at your own costs. Of course, as you cut your costs, that's cutting someone else's revenue, hence the cyclicality. But,
what's been surprising is they haven't been laying people off. And when we looked at, the one chart earlier, although they're pessimistic, they're holding on in the expectation that earnings will recover later in the year. The danger is, of course, that if earnings don't recover, then they all start cutting quite quickly at the same time.
Yep. And given what we've seen with credit availability, you could get a sort of a storm effect, couldn't you? Well, here we go. Credit is declining in all categories. We were talking about this before with the SLOOS survey. And here's data on actual volume of loans, in particular, securities in bank credit. That appears to be the weakest, but all areas are turning down now. US state and local income tax receipts. This is the annual change in billions, looking absolutely awful out there. US tax receipts were down 10% So somewhat surprising given what's happened to wages and to employment levels.
Yeah, I'm suspicious of this. I think there's, because the commentary is that this only happens during a recession. I think this is probably due to deferrals in tax receipts caused by the storm. So various states, including, I believe, California, were granted delays in the time period to file their tax returns. So that should mean actually you get better tax returns later on, but we're putting it out there.
US percentage of yield curve inversions. Hold on. Oh, I see. This is if you measure the yield curve in all the different ways,
Yeah.
1 month, 3 month, 1 year versus 5 year, 10 year, 20 year, etc. So 93% of US yield curve measurement possibilities suggest the curve is inverted, and that, as we've covered many times before, is a great predictor of recessions. Average monthly payment on new cars. Yes, Keith referred to this before. It's very expensive to be buying a new car if you're going to be doing it on credit, which I guess is the American way.
Yep.
So in summary, insolvencies are rising, retail sales are falling, global manufacturing is in recession, and I'd add to that the credit picture looks very negative. So bottom line, monetary policy, as we all know, acts with long and variable lags. And the world economy is already slowing, but interest rates continue to rise. So there's a risk of sort of overkill here. High interest rates are likely to slow the economy further in the coming months.
Thank you, Stuart. Okay, on to soft landing watch. Well, German factory orders massively beat expectations in June, came in at plus 7% month on month. But that was mainly due to a huge Airbus order, although the general commentary was that orders were pretty robust. So again, looking at the Eurozone PMIs, they're awful. But when you look at the actual data, new orders were good. And the last 2 months have been extraordinary. And again, we saw in the US that both the ISM manufacturing and non-manufacturing PMIs missed expectations, but the Atlanta Fed's GDP now forecast for Q3 is currently forecasting growth of 3.9% annualized. So actually, it's saying the US economy has accelerated from Q2 to Q3. And the US Economic Surprise Index is at its highest level since 2021. And part of that can be explained by actually only 11% of household debt adjust with market interest rates. So monetary policy does not really affect household spending very much, in that it doesn't affect the amount of interest they have to pay on their existing debts. And as a result of all that, although interest rates have risen, so debt servicing costs for households have not. And when we look at the NBER's recession index, well, it's fallen back down again, and it never really got anywhere near recession levels. So there is plenty to believe that a soft landing is possible. I mean, the Atlanta Fed's GDP now forecast shows the US economy is doing just fine, thank you very much. And, when you look at the hard data, the economy seems to be doing okay. So watch this space. We continue to believe on this podcast that the credit conditions, rising interest rates will slow the economy, and that is backed up by what I think is a clear trend in a weakening US jobs market. But if you want to believe in a soft landing, there's plenty of data to support that view. And quickly on to the performance of the UK economy. Now, UK Chancellor Jeremy Hunt claims the UK has done well compared to other G7 countries since 2010. And actually, he has a point when you look at GDP. So we're doing better than Germany and France. And since we left the EU in 2016, we've been doing just fine. according to this. But if you adjust for population growth, the picture ain't so good. Actually, we have then underperformed Germany and Japan and Canada, and particularly the US. And we're doing this about the same as France, but still a lot better than Italy. But what really matters for people's welfare is productivity, and our productivity growth has been absolutely abysmal, although so's the Italians. What that implies is the fact we have kept up with and beaten the other G7 members since 2010 has not been us working smarter. It's because we've been working harder. We have thrown more people and more time into the economy to produce more. And so if you break down UK GDP growth over the period from 2010 to this is 2019 to the last data, you'll see that GDP growth of 2.1% annualized over that period was achieved mainly through working harder and putting more people into the economy. Very little of it was through investment in capital goods. Productivity growth was only 0.6% per annum, so not great. So what that means is that prior to 2010, we were closing the productivity gap with Germany and France, and since then it has widened. This chart shows that the Great Financial Crisis marked a break in UK productivity compared to our European neighbours and competitors. You'll see that we were slowly closing the productivity gap before the Great Financial Crisis, and since the Great Financial Crisis, the gap has only widened, although Brexit does not really seem to have made much of a difference. Now, I wonder personally how much of the GDP growth the UK economy experienced pre-GFC was real, and how much of it was just moving bits of paper around the world economy. Stuart, your thoughts?
Yes, you're quite right to highlight the GFC rather than Brexit. There are some awful charts out there showing that the size of the economy and productivity, and there's a real change in measured productivity from 2008, such that compared to the trend prior to 2008, the UK economy is amazingly smaller than it would otherwise have been, 25 to 30% smaller. And you think about what that would have done to the UK deficit, budget deficit position, it's quite remarkable. And I don't think it's particularly well understood. There are various suggestions about the underperforming long tail of UK medium and small companies, for instance, but I don't think there's particularly good explanations of why productivity is so weak in the UK.
Well, I think when there were no rules on what investment banks based in London could do, that we were extraordinarily good at basically finding ways to rip off other people in other countries to the general betterment of our current account balance. And since those games have stopped, we ain't done so well. So in summary, the UK's economic performance since the Great Financial Crisis has been indifferent. Productivity growth has been poor. GDP growth has actually been pretty decent, but it's been supported by population growth and an increase in hours worked. So we've worked longer hours. We've worked longer, not smarter. And onto other charts, Stuart.
The cost of a wind turbine has increased by 38% in 2 years. And I believe there have been particular troubles with some suppliers, such as Siemens.
Yes.
So the other thing I think to say about all aspects of green energy is you must take all measures of their cost with a huge dollop of salt, because it so depends how you measure it. In particular, do you include the network costs, the cost to connect it, the cost for its intermittency? It's that there are so many charts out there saying green energy is cheaper than coal or gas or nuclear, but it really depends what you're including. Foreign corporates have essentially stopped investing in China. Now, I think this is no great surprise. We saw 18 months, 2 years ago, some big crackdowns on Chinese tech, on Chinese tutoring companies. Suddenly everyone remembered that you're dealing with a totalitarian regime which will and can and does change its opinion on things. So hence friendshoring, hence no marginal investment going into China. It's too risky.
Yeah. I have to say, Stuart, I've never touched China because ultimately I think, investments depend on your ability to enforce contract. And China, I just don't think you've got the ability to enforce contract, in which case you're relying on your being able to sell your Chinese A shares to some other sucker. And, it's not a gamble I want to take.
Yeah, my difficulty with this is that I've invested in some index funds of emerging market stocks. And of course, China is a pretty big component of that. So I then looked around and thought, well, hold on, there are some emerging markets ex-China ETFs. The trouble is that most of those are then heavily weighted to Korea and Taiwan, which aren't really emerging markets in the sense that I want to invest in.
Yeah.
So although we normally like index funds, or at least I do, you've got to be very careful what you're buying when it comes to emerging markets. The Fed's balance sheet fell by 91 billion in July as QT continued. But don't just look at change, also look at level. I mean, there we go. The pandemic led to an increase from 4 trillion to 7 and ultimately up to 9 trillion and has just been coming off. We're not even back to 8 at the moment. So yes, the Fed's balance sheet is shrinking, but from extraordinary levels.
Yeah. I really wonder how history will judge QE. It seems, it's far from a symmetrical policy. And I think the net effect has been to bump up asset prices and house prices everywhere, increasing inequality. Okay, and on to good news. Thank you, Stuart. And we have some really good news this week. And thank you to Discord member Jaded Persimmon for sending me this. So it turns out that trawling is banned inside UK wind farms. And that means they're being turned into marine sanctuaries. And trawling is really bad for the marine environment. Basically, you disrupt anything that grows on the seabed. And there's some statistics here. So the area of the Baltic, the sound between Denmark and Sweden, has banned trawling for 90 years. And fish productivity in the Sound is 100 times higher than in the Kattegat, which is just above it, where trawling is banned. Cod are 25% bigger in the Sound, and the stock is much denser. Other fish are also much larger, as you would expect. You allow fish in the trawled region to grow to maturity, and that means it's great for the entire marine environment because it means the bigger fish are much more fertile, actually, and they produce much more young. And those young then swim out into other areas where they are caught by the fishermen. So what, in effect, we have done by setting up all these wind farms is create a lot of marine parks around the UK. And that is just fantastic news. So thank you to Jaded Persimmon for that. And on to equities, Stuart.
So this is the all-world index. So weekly change minus 1.7%, still up 13.2% for the year. Turning to the UK, the FTSE All-Share down pretty much in line with those numbers, down 1.7% for the week. However, the year-to-date number is nothing like the world number. It's up just 1.3%. A small point is I assume this is the capital-only performance. You can add in a bit more for UK dividends, but still a pretty weak performance overall.
Okay. At this point, I'm going to take over because I've forgotten to put the titles on. So this is the Euro Stocks 500, or was it 600? So it had a poor week, down 2.8%, up 8% year to date. This is the S&P 500, which had a poor week, down 1.3%, still up 16.6% year to date. And the NASDAQ down 1% on the week, but still up an astonishing 33% year to date. And the Hang Seng down 1.9% last week, down 1.2% year to date. And this is the Topics, which has had a very good run as the yen has weakened, down 0.7% last week to up 20% year to date. And this is Bitcoin, which has defied my skepticism and is up 75% year to date, although is down slightly last week. Sterling at 1.27, much better than it was earlier in the year, down 0.4% last week, but up 5% year to date. The euro up 0.5% last week, up 3% year to date. The dollar index has had a bit of a bounce and was up a further 0.3% last week, but is down 1.4% year to date. VIX leapt after the NASDAQ sold off on Thursday, I believe.
Sorry to interrupt. I had a little look at VIX ETFs, etc., because I was amazed, like you were, with the low level of the VIX, and I was thinking about doing a cheeky, very small punt. But these things are very dangerous to touch. They're based on VIX futures, which have very high roll costs. The correlation between the VIX future and the VIX is not very high. So I had a look, but it's pretty stinky stuff, and I would avoid.
Yes, I did a My Worst Trade video on the iPath short-term VIX ETN, which did not do what I expected it to do. And so, like you, Stuart, this is years ago, I thought VIX is really low. I can insure my portfolio by buying a VIX ETN. And so if the market sells off, VIX will spike and, I will have insured my portfolio. Well, it didn't work out like that because, and you should watch the video, basically contango and the futures rolls meant that every day the VIX didn't spike, you were losing money, and you're losing about 20% a month. These are like big numbers. So you just can't hold them for any period of time. And it took me a while to work out what the hell was going on. But then when I did work it out, I got the hell out.
Okay, the Fear and Greed Index. We've come off a bit from extreme greed back to just greed. Presumably that's the slight weakness that we saw in the S&P. The cheapest hedge you have ever seen, apparently. The cost of buying a put has fallen to the lowest level on record. So presumably this is low VIX equals cheap to buy puts. This is a 95% put, so you take the first 5% hit, and then you'd be protected thereafter. But yeah, hold on. I suppose there are quite a few products out there that will try and take advantage of that. You'd have to be pretty nimble.
Yeah, I'm amazed though.
Consolidated equity positions. Goodness, investors are overweight equities. Well, this is a Z-score measuring, I guess, again, centered on 0 and a standard deviation of 1 for equity positioning. So this is fund managers saying, hey, we got it wrong, and chasing into rising markets, I suppose.
Yeah, absolutely. And I just thank our Discord member, Jaw It, for his contributions and regularly sending in charts we put in the weekly. It helps a lot.
Growth in this was in share prices or earnings, revenue and earnings for different sectors. So consumer discretionary has been the driver of earnings growth so far this year. But of course, it is the sector that will be most affected by the restart of US student loan payments. Conversely, we can see, of course, energy being very weak given the fall in oil and in particular gas prices. But some reason for nervousness about the revenue and earnings outlook then. Earnings growth has been negative as revenue growth returns to trend after the pandemic. Yes, I mean, margins has been the big story, hasn't it? How much they ramped up over the past year or so. And with modest revenue growth, margins are coming under pressure again. Hence, earnings are even more under pressure. Earnings per share year over year growth and expectations. So the dark blue here is actual. We can see some modest negative numbers, which are expected by FactSet to lead to a maximum contraction of 7%. But then magically everything comes back in line, and we're going to get a steady series of 10% year-on-year earnings growth, according to bottom-up analysts. I think both Keith and I would be skeptical of that outcome.
Yes, I think that's frankly delusional.
Earnings season has revealed big differences between companies. The majority of their earnings in the US and those with the majority of their earnings overseas. Domestically orientated companies have performed much better. And I think that that's no surprise given what we've seen in Europe in particular, being a low growth environment for companies. So yes,
yeah, and we also reported last week, Stuart, about US import and export prices, and their export prices had fallen 10% year on year. It's amazing. So given global trade's weakening and they've been suffering falling prices, then it's not surprising that revenues have been not so good.
Is that partly an energy effect, I wonder, if you're exporting LNG, if you're exporting oil?
Yes, possibly. Actually, LNG would be a big one.
Analysts have been revising higher their earnings expectations over the past week. I would suggest this is very much like fund managers closing the stable door after the horse has bolted. We can see, though, next 12-month earnings per share forecast for the S&P in the blue line here, which has been picking up over the past couple of months. Emerging markets, too, have begun to show a little bit of life after pretty remorseless downgrades over the past year or so. EFI, so developed markets ex the North America, have been reasonably strong all year on this number and have perked up quite a bit in the last reading. Insider transactions ratio. So insiders have turned bearish again. They are selling. Cash, of course, we know you can get about 5% on a money market fund. So the argument is, why would you buy US equities yielding about 1.8%, or if that's a dividend yield, or an earnings yield of about 4%, i.e., a PE of about 25. So this is a rather sort of naive calculation. I agree with the result, which is to be cautious about US equities. I'm not sure it's a great piece of analysis to compare cash rates with a forward PE.
Okay, thanks, Stuart. On to commodities. Well, this is an interesting chart showing proportion of US corporate capex that's going into commodities, i.e. not much and not recovering, and tech. And so the US is investing a lot in AI and technology, but neglecting the basic materials like copper and oil. And when the world economy recovers from its current slowdown, then I think you go straight back into a tight oil market. And if we're turning now to energy commodities, this is Brent, which had a very good week, actually, up 2.5%, and is now flat on the year. And WTI had a great week, up 3.7%, up 3.2% on the year. Now, earlier in the week, Russia announced that it would cut exports by 300,000 barrels a day starting in September in order to balance the market and presumably to appease Saudi Arabia, who have been cutting on their own. And the dark red line is Russian crude oil exports by sea this year. And you'll see that while the rest of OPEC have been cutting, they ain't. But of course, then on Friday night, there was this attack on a Russian crude tanker. And this is from Robin Brooks on Twitter showing the exports by the various ports in the Russian Black Sea. Now, actually, when you look at Russia's oil exports, seaborne exports, then the Black Sea is not very large. The vast majority go through the Pacific or the Baltic. Only between 300,000 and 400,000 barrels a day go via the Black Sea. So it's not huge, but it's in the context of a tight oil market, it has potential to tighten it further. Good news for the oil market is the fact that Venezuela have renewed Chevron's operating license, which opens the way for renewed US investment in Venezuela. And reminder, Venezuela has the largest oil reserves in the world, apparently, according to them. So if investment came back, there is plenty of room for Venezuela to produce more oil. And you'll see that as part of that, rapprochement, the US has started importing Venezuelan crude again. The oil market is tight and oil inventories have started falling. Last week, there was a 17 million barrel drawdown in US crude inventories, and that is the biggest ever in history. You'll see that inventories are low throughout the US. And Saudi have been cutting their production in line with what they've been saying. Although they did say they'd cut by 1 million. Well, the latest data for May shows that actually production fell by 500,000 and exports fell by 390,000. But energy stocks are very cheap compared to consumer discretionary. And if the oil price rally has legs, then presumably oil equities have room to rise. And turning to data specific to the oil market, you'll see that the total crude inventories, according to us, was down 10.4 million barrels. So again, a big crude draw. US oil production was flat at 12.2 million barrels. And the Baker Hughes rig count continues to fall. So unless US productivity continues rising, you would expect oil production to start falling. Moving to natural gas, well, Dutch natural gas futures rose by 1.2% last week, but are down 62% on the year. UK natural gas futures rose by 6.7%. They remain down 58% on the year.
It's a little bit of personal finance related to the gas market. Last time I was on and we were talking about the fall in gas prices, I wondered whether that meant we could get better rates from different energy suppliers for our personal energy consumption. There's very little evidence of much ability to do that. I had a quick check. There are a few products on offer, but I think later in the year, when the price cap gets, I think, reduced again, that might be a better time to be looking. But for the moment, there's very few deals out there for people to take advantage of.
Great, thanks, Stuart. So this is US natural gas futures down 1.1% on the week, down 42% year to date. Coal bouncing off its lows, up 1.5% on the week, but down 65% year to date. And reminder, China continues to build coal-fired power stations and its emissions are rising. Uranium recovering from its little dip and back on the bull market. So up 0.2% on the week, up 15% year to date. Industrial metals, Stuart.
Here we've got aluminium. No clear trend really there. Up 1.4% for the week, but no real trend since May, I would say. Cobalt, flat, weekly change 0, down now 35% for the year though. Copper has fallen a bit recently, from $4 a pound to 3.8, and this week falling 1.4%, pretty much flat for the year. Chromium, weekly change up by 0.8, off 10% for the year though. Iron ore, a week, as it were, of 6.1%, making the year-to-date change minus 7.7%. Do you know anything about that? That's a reasonably large move.
Well, the thing is, we had been puzzled previously about the bounce in iron ore prices, given that we know that Chinese manufacturing is not doing so well and growth there was weakening. And we commented, I think maybe last week or the week before, that this did not seem sustainable without a sustained rise in Chinese construction. And we know the Chinese construction sector is not doing well. So the fall comes as no surprise, frankly.
Lithium off 6.4% for the week and is now halved for the year. Neodymium, no change on the week, down 42% for the year though. Nickel, very quiet week really, off by 0.4%, down 28% for the year. Tin, 3.4% off this week. Year to date though, it's one area of strength, up 13%. Ferrovanadium, not much really happening here over the week, down by 0.6%, off 13% for the year. Zinc up 2.3% on the week, still down 15% for the year though. Turning to precious metals, gold up by 0.9% for the week, 6.5% up in dollar terms for the year. Silver off 2.3% for the week though, and is pretty much flat or slightly down 1% for the year. Not very happy picture there. Platinum off 1.8% for the week and 14% for the year. So only gold really showing much strength for the year. Rhodium flat on the week, down 66% for the year to date. Palladium up 1.7% for the week, but I think if you look at the chart, it's more that it's trundling along some sort of bottom after a pretty painful year, down 30%.
Yeah. No, I remember like post-pandemic that rhodium was forecast to go to the moon. And it just goes to show that, you know, there's strong mean reversion. When
well, there was a lithium bubble as well, wasn't there? I remember being asked about lithium stocks, and I know nothing.
Okay, thank you, Stuart. On to rates. Well, it was a bad week for bonds, actually, due to the continued sell-off in long-dated bonds, particularly in the US, after Fitch had downgraded the US sovereign debt market, and that spread to long-dated bonds throughout the world. So as a result, although short-dated bonds, actually, their yields fell during the week, long-dated bonds, their yields rose. Now, that was partly unwound on Friday, but still, over the course of the week, long-dated bonds fell and their yields rose. So this is UK change over the course of the last month, actually down slightly, although I know from bitter experience that UK long bonds had a bad week. This is the US. Now, you notice that yields at the long end in the US have been rising despite the fact inflation is falling and the economy appears to be slowing. Now, how much of that is due to indigestion from the expectations that the US is going to start issuing large amounts of longer dated bonds in the coming quarter, and the fact that the economy has so far remained resilient. So on Thursday, Bill Ackman, the US hedge fund manager, announced that he was short US Treasuries in size, saying that he expected long-dated US Treasury yields to rise as far as 5.5% in the near term, because he believed that bond markets had not priced in rising inflation. He thought the rise of inflation would likely be structural, and he cited deglobalization, higher defense costs, the energy transition, growing entitlements, and greater bargaining power of workers as reasons that inflation would be structurally higher going forward. Now, I would say that apart from higher defense costs, which is frankly a marginal contribution to inflation, none of those are really new. And although it may be possible for long yields to hit 5.5% briefly, if the huge stock of outstanding debt had to be refinanced at those rates, everyone would go bust. Reminder that the total stock of debt is now 50% higher than it was at the GFC. So we simply can't reprice all that debt at much higher interest rates, because then the economy goes into an immediate recession as everyone spends much more on their debt servicing costs. And then on Friday, the non-farm payroll numbers came out weak, and 10-year yields fell sharply, which was bad for Mr. Ackman. And talking about globalization, well, this is global trade as a percentage of GDP. And I don't think you can really say that we've been having deglobalization. I think you can say that it's peaked and has held steady. And given that, this is the period of pandemic, as I wonder what the figures for last year were. Certainly US trade, it is down from its peak, but I don't think you can extrapolate a trend of deglobalization. I think that we're addicted to cheap goods, frankly, from the Far East, and I expect that to continue. Now, lots of hedge fund managers are also bearish bonds, and frankly, that looks like a crowded trade to me. And crowded trades are dangerous. Fund managers, however, are overweight bonds. So the long-term money is overweight. The short-term money is short. Place your bets. Okay, so turning some charts, there's a UK 2-year actually coming off. So UK 2-year yields are falling. And 10-year had a bad week, though came back a bit on Friday. 30-year, not so great. This is the US 10-year, and you'll see that does look like a blow-off top to me, he says, hopefully. But, you can see from the positioning that a lot of hedge fund managers short, and I think they've been caught out. This is German 10-year, Italian, Greek. No real sign that bond yields are falling as the EU economy slows. Stuart, your views?
So equities, I'm still very nervous of US equities, primarily based on valuation. You look at something like the Shiller-P ratio, and it gives me nightmares. You look at world ex-US, and I think you've got a much cheaper bet. And I was looking at some data recently that suggests that the US earnings growth, while it has been better than the rest of the developed world, hasn't been that much better. And of course, higher earnings growth is really the justification for why you'd be paying such a high multiple in the US. So that's my highest conviction exposure. It hasn't worked. I'm persisting with it. I go round and round, and I can't bring myself to buy the US. Bonds, previously I was suggesting that I was mainly holding very short-term bonds, basically proxies for cash. Now I'm prepared to take a bit more risk. If I was Keith, I'd be looking for the Austrian 100-year bond, but I'm not. A more medium duration bet feels about right to me, as we do seem to be about to hit the crescendo of a recession. Gold, I'm not really sort of a buyer or a seller. For me, it's about what sort of position size in the portfolio I hold. For me, it's insurance. I've got about 3% in gold. Industrial commodities and energy commodities, I haven't really got a strong knowledge base. I'm definitely interested in the oil story about the lack of investment and the likelihood of a price squeeze upwards again. But of course, that's a story for later during the recession, when hopefully prices will be much cheaper.
Yeah, on energy commodities, I think when we get the recession, then I fully buy the story that we're going to be short oil going forwards, and I think oil prices will rise rapidly when demand come back fully. But I think we have a recession before now and then, so I would be looking to buy oil companies at the bottom. Okay, concluding comments. Well, interest rates continue to rise everywhere. Labor markets remain tight but are weakening. And I think the takeaway from the non-farm payrolls was not the fact that the headline number missed slightly, it's the fact the US lost 585,000 full-time jobs in July. The labor market in the US is definitely weakening. We expect the lagged effect of rapid interest rate rises over the past 18 months to increasingly affect the global economy over the coming months, leading to a recession. And I would also add that data from the Senior Officers Loan Survey shows that credit conditions are tightening, which will also slow the economy. Stuart, what do you get up to this week?
Well, standing in for Richard, I can say exactly what Richard would say, which is I've been up to very little indeed. Okay, my performance year to date has not been very good. I'm down 2.6%. I've got, as usual, the drip of income, but I've been hurt by my bond proxy. So although my portfolio is very different to Keith's, I'm actually subject to the same overall gravitational effect of the change in bond yields. So my infrastructure stocks, my lending stocks, my REITs have all been hurt, really. My hope is that revenue growth in the infrastructure and REIT sectors will mean that eventually higher dividends will be possible. So there is some growth aspect to the bond proxies that I hold. As I mentioned last time, I've been slowly buying some Japan equities based on a valuation and a restructuring bet. This is not in size. This is basically from reinvesting income. I've also bought a few linkers on exactly that basis. But I did want to highlight one thing, though, which has come to my attention. And it's something I've sort of known about, but I had a bit more of a look into. When people ask me, what should I buy? Well, one of the go-to answers as a conservative investor should be a world equity fund. You get every country, every industry, every stock, every currency. But the trouble is, when you dig into it even a bit, it's pretty scary to buy something like a world equity tracker. The US is now 69.6% of the world index.
Wow.
The next biggest is Japan, basically less than a tenth of that at 6%. So the go-to solution is, in a sense, pretty scary. You're getting a US equity bet. And then if you look at the largest holdings, it's Apple, Microsoft, Amazon, Nvidia, Alphabet, Tesla, Meta. So yes, it is the most diversified, best long-term fire and forget solution, supposedly, but you're getting such an exposure to US and to tech that it makes me rather worried. By contrast, this is a fund that I could buy and feel like I was getting a sensible long-term prudent position. So the go-to bet that reassures me is a FTSE World Equity Index, but tilted towards high yield stocks. So it's diverse. You've got a value tilt on the bet of growth has just had too much of a run for the past decade, and it's much less US tech. So the FTSE All World High Yield Index is only 46% in North America. So a bit of that is Canada, but say you're more like 45% in the US compared to basically 70% in the regular world index, 25% in Europe, 16% in the Pacific, 11% in emerging markets. It feels much more diversified in a sort of true sense. It's got almost 1,800 stocks on a P ratio of 11.3 and a price to book of 1.6 and still reasonable earnings growth. So this to me feels like a more prudent way if you want a diversified equity bet, because the world index is so tilted to the US at the moment. How about you, Keith? What have you been up to?
Thanks, Stuart. Well, I had a pretty terrible week as long bonds sold off. Thank God for that bounce on Friday. So down 2.6%, down 8.3% year to date. Rubbish, really. No buys, no sells. Now, talking about TR24, which is the short-term index-linked gilt we have previously been discussing on the podcast and how we think it has a very decent yield heading into its maturity on the 22nd of March. Well, according to Yield GIMP, it currently has a break-even RPI rate of 0.8%. So it's saying that essentially any RPI above 0.8% annualized between now and March, you'll do better owning this than you will owning a conventional gilt. Now, we know that RPI has been coming down, but is still extremely elevated in the UK. I can't remember exactly off the top of my head what the number is, but headline UK inflation is 7.9%. So the idea that it will collapse to 0.8% annualized between here and March just seems extraordinary.
Now that is an annual number. It's not a monthly average or anything.
No, that should be the annualized number.
Yep, seems a great hidey hole, a great prudent place to be.
Yep, absolutely. Okay, and turning to my big bet, which is long-dated UK gilts. So this is the long-term chart of T68, the 2068 gilt. You'll see that when it was issued just above 100. It hit a peak of 330 and is now 73. So I expect inflation expectations to normalize as central banks around the world get inflation under control. And as they do so, the price of T68 to normalize. Fingers crossed. Sorry?
I think that the bid offer it's not as tight as one would have thought for a government bond. Is that the sort of spread that you suffer in practice?
No, it's not. I mean, one of the frustrations of dealing in gilts is that it's an over-the-counter market, and actually you don't know what the price is going to be. So my broker always trades well within that spread. And sometimes you can trade towards the bottom end of that spread, so if you're buying, actually you can be buying towards 72.85 and selling towards 74.35, depending on what the balance is on the market. Because I think, frankly, the stock exchange numbers tend to lag, and you don't know really where the market is unless you're paying up for some live feed, which I don't pay for. So I'm told the true spread is about 25 basis points, which is still substantial, but it's a lot better than 1.5%. Or actually, it's even more. No, it's 1.5 here. Yeah, so you're talking about 2% spread quoted. Okay, that's it. Thank you very much to Stuart Owen for stepping in when Richard is away. Please can you press like and subscribe to the channel. In the meantime, it's goodbye from Stuart Owen.
And it's goodbye from Keith Jordan. Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information, nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.